Hello traders, welcome to another video on Bitcoin options. Today we're going to be taking a statistical approach and looking to find underpriced and overpriced options to immediately take advantage and profit, basically. So I did a first video on options on just puts and calls and the basics. I did a second video on options strategies / options plays, such as strangles and straddles. And in this video, we're going to be looking at the website, Skew. And we're just going to be looking at a few facts and figures that you can look at in real time. And immediately when you see an inefficiency or you see something that you can take advantage of, you can go to the site. You see something, you can immediately go to Deribit and execute an order. So hopefully by the end of this video, if you do make it through the entire video, you will be able to spot these inefficiencies very quickly so that you can be the first one to take advantage. Okay, now the main goal of what we want to do today is let's try to find a put or a call with a very good break even. Basically try to pay a low premium if we're buying and try to offer or sell a high premium when we're selling. Now when we look for premiums that are underpriced or overpriced, we're going to want to look at implied volatility. Now when we look at implied volatility, we can just look at those numbers here, or we can look at something known as a volatility smile. And these four here are known as a volatility smile. What is a volatility smile? Well, a volatility smile is referring to the three kinds of options that are at the money, options that are out of the money, and options that are in the money. Now, the options that are around the money or really at the money are going to have low implied volatility. You can just see that kind of across the board because the current price of Bitcoin is 7,930. So you can see that the implied volatilities are a bit lower near at the money. Now, when you get a little bit farther away from the money, those implied volatilities rise, as you can see here. This is known as the volatility smile. Another thing that puts a smile on my face is my guide that I have just released. I released my Master of the Books guide this Friday, last Friday, and it gives strategies on how to trade the order book, how to trade order depth, and how to trade order flow. So basically looking at supply and demand of limit orders in the order book, how to take advantage of that. Also looking at the aggression of the market or looking at the market buys versus the market sells, and how to position yourself in a trend before others do. So if you're interested in learning more, or if you want to join our special professional community, you can click the link in the description below and become the master of the books. How was that for a segue? I think that, okay. You guys probably already skipped ahead to like when I started talking about options again. But that's fine. Your life is your life, okay? Now, where was I? Oh, I was talking about volatility smiles. Now, what we want to do within this volatility smile is really look for, when we're bidding or when we're buying an option, we want to look for a very low implied volatility. Now, there is an implied volatility here that's kind of poking out as very, very low. I think you guys can see it's this guy here. Yeah, the 8,500 strike, buying a put, 55.72 implied volatility percent. Okay? What do we do with this information? And you might ask, well, how do I take advantage of this? Tell me what to do, okay? Well, I can't tell you what to do because I'm not a financial advisor. I can show you what I would do if I see this kind of structure. Let's go to the 8,500 and let's get that premium that it currently is at, 0.00755. Now it's 0.0075. Now, let's first find what the profit would look like. Do not look at that. That is something different we may talk about. Look at this. So 8,500 with a 0.075 premium. Now, let's just look at the profit and loss of different prices that if the price of Bitcoin settles at, this is what we would get with this kind of setup. Now, with this very low implied volatility, with buying at the current bid or oh man, that implied volatility is really going down. That's great if you wanted to buy a put. Now remember, guys, what we're doing here when we're bidding on a put, when we're buying a put, we're betting that Bitcoin goes down. We're betting that Bitcoin goes below a certain price. Now you can see here that let's say Bitcoin settles at 75.25. You would make 0.05 Bitcoin with one put option bought at, let's say price settles at 82.25, you lose 0.04. Now, if we want to, let's say price sells at 7,700, you make 0.028. Now, if we want to find the exact price of our break even, which can be very important, let's go to 8,500 and let's type in 0.075. Your break even is 7,907, meaning that if price settles below 7,907 on your long put, you have made money. If price settles above 7,907, then you might be in a bit of a drawdown or a bit of a loss. Now, why is this special? Why did I just do all of this? Well, I want you guys to see something else now. This is a very low implied volatility, meaning it's probably not the worst idea to buy this if you're bearish. You don't want to just buy this because it's low. You want to buy this if you're actually bearish. Let's compare it to another. Let's compare it to the 8250. So really what I'm going to look at here is the 8250 put bid is at 70.69 implied volatility. Let's go plug the numbers in and let's go see what the difference in the break-even price of this very low implied volatility put is different than this kind of more normally priced implied volatility put. Okay, 8250, we 0.0535, 0.054. I'll be nice. I'll do 0.0535. 0.0535, perfect, with a strike of 8250. All right. With this, you can see your profit is not. Oops, come on. Your profit is not as. Yeah, your profit is not as good. You can see that. Well, I can just show you the answer here. With this kind of setup, with this very low implied volatility that we were able to spot using that site, you have a break even of 7,907. Hey, how about 0.054 with a strike price of 8250? You know, that's what we're looking at. Or 35, yeah. Yeah. Do you guys see the difference in the break even? Do you see just how much worse your break even is? Now you're only break even if price settles below 7,831. This is the importance of looking at that volatility smile. And being able to spot what is a low implied volatility and can give me a very good break even, what's a high implied volatility and, you know, might not get me a good break even if I go long, but will get me a very good break even if I actually short a put or short a call. Yeah, this is a far cry from 7,907. And you can see that kind of reflected here as well. Price needs to be below 7,837, I believe the number was for break even. For you to be profitable. So this is probably not the best setup, and that is why we look at this. That is why we try to hunt down options that are underpriced or overpriced. And you could try to outbid. I mean, I'm not saying do this. This is your own, financial. But you could try to maybe outbid the 8,500, which means that, if this guy's bidding at 0.0745, you try to get a bid filled at 0.05 or 0.075 or 0.075, 5 or something, somewhere around there, because this implied volatility is great. Now, I think what we should do is do the exact opposite. We're talking about plays where you go long on an option where, you buy a put or you buy a call, and here you'd obviously be buying a put. What if we looked for very high implied volatility where we're looking to short? We're looking to, also known as really sell a put or sell a call is the proper term. You could say short, but it's sell a put or sell a call. Now, I think that the 8750 looks like it has a pretty high implied volatility. Let's go look at 8750 on the put ask. So 8750, we're talking here. Put ask is quite high. Yeah, 99.9. So that's a 0.112. Let's just say we were to sell a put. So we're selling a put, guys, at 0.1. What was it? 0.111 or something like that. Let me see. 0.111 is fair. Yeah, it's fair. A pretty high implied volatility at 8750. Okay. So here we're betting on the market going up. We make money if the market goes up because, we sold a put. Now, with this very high implied volatility, when we sell that put, we actually do have some nice profitability at this because, guys, look at these numbers here. If price settles above, let's just give the answer here because it's going to be a lot easier that way. So 8750 and a 0.111 to get the exact. Oops. Here. So it's 78.76. Yeah, that makes sense. So above 78.76, you profit. So if Bitcoin settles above 7,876 when you sell this put at this premium, at this strike, you profit as long as Bitcoin's above 7,876. Now, how much you make isn't really phenomenal because the maximum profit is only the premium, which is 0.111. But let's say price settles at 82.25. then you make 0.047. Let's say price sells at 8,050, then you make 0.02. Here's the issue with selling options, guys. If you were to sell a put and price tanks and settles at like 7,000, yeah, you lose a lot. Let's say something horrible happens and prices like a Bitcoin settles there and on June 14th, yeah, you really lose. If price settles at like 7,700, you lose 0.02. But you do have a very good break even, as you can see here with this setup. Now, how did I find that? Once again, all I did was I looked at the option chain of the June 14th expiration. I'm looking for underpriced, cough, cough, here, or really low implied volatility, or overpriced, cough, cough, high implied volatility options. I look at the premiums there, and I see the break even. And then I decide if I want to grab that option or not. Now, another one that we can play around with is, that is a very low implied volatility there. Guys, look at the strike price of 9,500 with an implied volatility of about 45%. This is a different chain. This is the June 19th, so that would be this one here, the 28th. Now, on these guys, it was the 9,500, it was the put bid, I believe. So buying a put, betting that the market goes down, of 9,500. Yeah, so the put bid at 9,500 costs about 0.2 exactly. Beautifully, very, very low implied volatility of this guy. So let's go plug this guy into our little formula. 9,500 strike. It would be a bought put, 9,500 strike, and a simple cost of 0.2 for premium. All right, you're off the chart. No, not exactly. It's not off the chart. So basically, you're betting that the market goes down. So if the market settles at June 28th around, lower than this, your profit really can accelerate. What? If price settles at 7,175, you make 0.12 Bitcoin. Nice. If price settles above, you do lose money on buying a put at that price. Now let's look at the calculator to see the exact. So remember, this would be 0.2. Yeah. So break even is on this long put is 7,917, meaning that on June 28th, you need price. If you do what I had just shown, you need price to be below 7,917 to profit. All right. And if price is below 7,917, you make money. Great. How did I find this? Well, all I did, guys, was I went to these guys here. I went to this one here. I looked for a very low implied volatility to really locate an underpriced option, which was the bid on the put at 9,500 is an underpriced option. You'll see these are priced a little bit strangely too. All right, let's go past pricing. This is one way you can just pick off these kinds of low orders, but I highly recommend, guys, you don't want to do this unless you're bearish. With the puts, of course, because if you're buying a put, you're bearish. You're hoping the market goes lower. Neutral plays like straddles and strangles, those kinds of plays you can make on these. You'd have to combine them with a call, of course, using a put and a call. But if you're just going to be buying a put, then you may want to either hedge with a different market, not with a different market, but hedge by potentially buying Bitcoin and then also buying a put so that you don't lose everything. If Bitcoin really goes up and your put bid is just, your put buy is just like, ugh. So do be careful when you do those, and also be very careful when you sell options, such as selling a put or selling a call, because that is when your profit is capped, but your loss can be a lot larger, as could be shown with the options P&L little chart. Now, another thing that I want to look at really quickly is implied volatility versus realized volatility. This is exactly really what it sounds like. Implied volatility is what we always look at with options, and realized volatility is what the volatility was with the 3-month bucket taken every day. You can see that historically the implied volatility was a lot higher in May than the realized volatility. So you can think about it that the traders were betting on a lot higher volatility than had actually happened. Now you may say, well, in that situation, how do I profit off that, Bennett? Tell me what to do, kind of thing. Well, if you notice that the implied volatility is a lot higher than the realized volatility for quite some time, that might already be built into the market. But what that can also suggest is that a lot of traders are betting on high volatility, because if a lot of traders are buying puts and calls, that's going to raise that could raise the premium, because if a lot of people want to buy something, that could raise the premiums, which could potentially elevate the implied volatility. So basically, a lot of people are betting on puts and calls long. Now, you could do the opposite. I'm definitely not saying this because it can be dangerous to write/sell puts and calls. But if you notice a major discrepancy between realized volatility and implied volatility, maybe selling a put or short straddle, or selling a put and selling a call may not be terrible. Here you can see that implied volatility and daily realized volatility are not that far apart, so you can't really do as much with that now. But here there's a moment where realized volatility was higher. But in moments like this, where it's this extreme, like May 17th, May 18th, would that have been a good time to bet on low volatility? May 17th, potentially, yeah. Potentially, because the market is very volatile, but settlement, meaning if you were to buy like 6 days away from expiration, maybe this price actually does settle within that range, as you can see here. If you got something like with the strike price of 8,000 and price settles around here, you may be able to settle in the money with a profit. So maybe it would have worked well to sell options here. I don't know. I would have had to look at the premiums and, of course, the actual implied volatilities of those. But that could have been a play. So this is just something you want to look at for implied volatility versus realized. Now for something that's probably going to be the most popular thing from this, it's these two guys here. This is the buy-sell ratio of options, and this is the put-call ratio. Let me quickly go through both, and then I'm probably going to want to end this video soon. What did I do that to? 6-1, I think. I want to make these like equal. Okay. Is that equal? Okay, you're not cooperating here, dude. Come on. Is that 6-1? Yeah, they're kind of matched up. Wish it was easier to do that on this site. When we look at the buy-sell ratio, what this is talking about are of the options, are more people buying options or more people selling options. When people buy options, they're betting on volatility most of the time. And when they're selling options, they're betting on low volatility. Because if I buy a call, I am hoping that the market is going to rise on high volatility as well. And if I sell a call, I'm hoping that the market does not rise. I'm hoping that the market goes down. Now, when I both sell a put and sell a call, then what I'm hoping that is that the market is moving on low volatility. When I buy a put and I buy a call at the same time, I'm betting that the market goes on high volatility. So one way you can think about these is using this as a gauge for, are traders betting on high volatility, or are they more betting on low volatility plays with the buy-sell ratio? Now, when we look at the put-call ratio, this is one of the more famous or well-known ways to look at puts and calls. Statistical data-wise, it's just looking at how many people are trading puts versus how many people are trading calls. Now, with how many people are trading puts versus trading calls, we can look at the current date. A lot more traders are trading puts. When a lot of traders are trading puts, that's a lot of traders betting that the market's going to go down. Not many people are trading calls. Now, how do I find a little bit more information on that? Well, that's where we get the option flows. Look here. You can see that a lot of people are selling puts, and a lot of people are also buying puts as well. These two are probably why this is so high. Not many people are selling calls at all, and a decent percentage of people are buying calls. Now let's actually turn this into a bearish/bullishness kind of thing and put some meaning to it. Well, if a lot of people are selling calls, a lot of people are betting that the market is going to be moving higher. That's what they want. And if a lot of people are buying calls, a lot of people are betting that the market's going to go higher. You could think about it this way. I don't know if I would, but 25 plus 42 is 67. So 67% of these options are betting that the market's going to go up. Because when I sell a call or buy a put, I'm betting that the market goes down. Only 1/3 of traders are doing that. So a lot of people are betting that the market goes up, as you can see here. And that's not really reflected here because it looks like the puts are very popular. But actually, a lot of people are selling puts, and not as many people are actually buying them. So with a lot of people betting that the market is going to be rising in the near future, how do we deal with this information? Well, this depends on if you're bullish or bearish, but you could try to pick off an overpriced premium, which means that if a lot of people are, trying to sell a put, and a lot of people want to sell, then they're going to continue to sell, at I sell at 0.2, and then another guy tries to offer at 0.199. Another guy tries to sell at 0.198, and you kind of get what I'm going with here. Eventually, with that many people trying to sell puts, the price of the put's going to keep dropping. Maybe you could buy a put, and when you buy a put, you get a very, very, very low premium, and you also get a low implied volatility, so you can pick up something like the, was it the 8,500 with the 0.074? Yeah, it was that. Maybe you could pick off something like this and just, market buy like that and get a very good break-even rate. Now, I think that this actually all comes together the more I think about it. You see here on Skew that a lot of people are betting that the market goes up. And it's not surprising that the June 14ths, that the put bid, meaning I'm betting that the market goes down, is as cheap as it is. Because so many people are betting that the market goes up. And so many people are selling puts that buying a put would be cheaper because so many people want to sell the puts. So this is another thing that you can do. And I think this all comes together with you're looking for overreactions by the market. And looks like people are way more people are selling these puts. And you can see here, this put has a very, very low implied volatility. I should take notice. Maybe I want to buy this put and either hedge it or take on high risk and unhedge it and just leave it, just buy a put and just hope that it settles in the money on June 14th. So that's going to do it for this video, guys. Just to recap what we have talked about, we talked about looking at the volatility smile and looking at the money volatility, implied volatility, looking at in the money, out of the money, in the money, out of the money volatilities here as well. We also looked at the June 28ths, which are here, the June 14ths, and you can look at these, if you do want to. I didn't want to talk about these today. I don't want this to be like a 40-minute video. It already is kind of long, so I kind of skipped those two. Maybe I'll talk about them in the future. We looked at realized volatility versus implied volatility and how you can take advantage of a lot of traders betting on high volatility when in reality the volatility wasn't as high as many traders had betted on. And finally, we looked at these three here, looking at are more people selling puts or more people selling calls? What are traders doing? And historically, what has been the buy-sell ratio and the options call put ratio? And how popular were the puts? How popular were the calls? You can see a lot of people selling calls here. Selling puts here. And then this all comes together when you look at these three. You can say, well, it makes sense that this quote unquote is a bit underpriced with a very low implied volatility because so many people are selling puts. You can use this all together. It may take a few hours or a few days for you to really grasp this and to put into practice to actually, entering orders and saying, okay, 85, where is it? This guy here. With this 8,500, hey, I want to bid at 0.0735 because if I do that, I get, really good break evens. And I bet that the market's going down. So, that actually brings me from 8,500 at 0.074. That's the original. Break even at 79.14. If I make that at 3.5, my break even's at 79.18. Yay. I got $4 of break even on that long put. Great. It could help. It's going to expand your profits and minimize your losses. So. All right, guys, that's gonna be it. You can play around with options on just for fun, without any money, or you could try to do this with real big boy money if you want to use real big boy money. I would highly recommend taking a look at this, practicing it a bit, trying to pick off very low implied volatility or pick off very high implied volatility. Measure the mood of the market and see sentiment here, and then go from there. Best of luck, guys. Check out my guide, and happy trading.